Hi guys, welcome back to the Baseline. Thank you so much for joining me today. So the for rent sign still glows under the streetlight. Everybody's seen it, but the mailbox, it's empty. And the house next door, bought by a company with a name that sounds like a spaceship, Haven Rock Residential Holdings. And that's the contradiction of our time. Every headline nowadays seems to be screaming housing crash. Yet, guys, at the same time, Wall Street is buying houses like it's Black Friday. Because when the next housing correction hits, it won't be an actual crash, I would imagine. I imagine it's going to be more of a transfer from families to funds, from workers to wealth managers, and from my home to their asset. So get this, everyone. According to Redfin and CoreLogic, institutional investors bought nearly 1 in 5 single-family homes sold in America last year. Now, that's the highest share on record. Meanwhile, small landlords are quietly leaving the market, and they're getting squeezed by high interest rates, rising insurance, and new local taxes. So that means the people who once provided affordable rentals, your neighbor, your uncle, your mom and pop investor, the retired couple down the street, they're selling their duplexes to the exact same corporations that own our credit and our credit card debt. And here's the interesting punchline to the whole thing. Because while we're all being told don't buy, the markets are too risky, BlackRock, Invitation Homes, Tricon, they're all buying everything nobody else will right now. So that's not a crash. It's more like a form of a consolidation. So if we take a breath and pause for a second and go back to 2008. You guys remember 2008? Crazy times. Banks collapsed, families lost homes, and the same banks that caused the crash bought those homes back for pennies on the dollar. Now it's happening all over again, only it's happening slower, quieter, and it's perfectly legal. Because today, a 7.5 mortgage rate has priced out millions of people. Wages are up 4%, but shelter, inflation, it's still over 6%. Renters are spending more than a third of their income just to stay put. And when people can't buy, Wall Street moves in to help. It's like the casino handing you a drink after taking your paycheck. They call it housing as a service. We all call it never owning anything again. The average corporation or the average corporate landlord right now holds 80,000 units. Invitation Homes alone is valued at somewhere near 25 billion. So compare that to the local landlord with 3 properties and a lawnmower in the trunk. They can't compete with that kind of leverage. And then we have mortgage-backed securities. They're back too. Only this time, the risk isn't on subprime borrowers. It's on entire neighborhoods turned into bond portfolios. It's a monopoly board, digitized and securitized. So it's kind of like owning a home. Like owning a home in 2025 is like trying to play chess against an AI that already knows your next 10 moves. Your mortgage rate rises because the Fed fights inflation, but that same inflation comes from the rent increases the Fed can't control in the very first place. So it's like that firefighter starting the fire just to charge you for the water itself. And the irony is this, when small landlords raise rent, they're called greedy. But when Wall Street does it, it's shareholder value. And it's an interesting double standard, definitely an interesting play on words. But right now, reports suggest that new municipal tax proposals, they have vacancy fees, rental caps, even landlord insurance surcharges. And they're accelerating sell-offs by mom and pop investors. But those rules rarely apply to institutional funds structured as real estate investment trusts, our REITs. They get deductions, depreciation, and bulk buy discounts straight from the Fed's liquidity window. So the same policies that were supposed to protect tenants are driving the people who once housed them completely out of business. And the housing shortage, it seems to be partly engineered, because when scarcity is predictable, profit is almost guaranteed. So this is where the story flips a little bit, though, right? Because what looks like a market failure is really a market redesign, a shift from individual ownership to perpetual rentership. And now a world where homes aren't built to live in, but they're built to trade. But here's the part they don't calculate into their spreadsheets. People still remember what stability feels like. People still want a backyard with kids playing in it. They still want a community. They still want a front door they can actually call their own. Now, that desire cannot be shortened and it can't be securitized. So when you hear the housing crash is coming, remember this. Crashes hurt the leveraged, not the liquid. And if the next rescue plan once again saves the giants while families drown, the real question becomes, isn't if the market resets, it's who it resets for. Because the bubble isn't bursting, it's being harvested. And that harvest season, I think it's just beginning. Or a lot of you guys might think it's already begun. All right, guys. Do I have this all right? Do I have it all wrong? Let me know in the comment section below. What are you guys seeing out there? I read and reply to all the comments, and of course, looking forward to your guys' opinion. So thank you again so much for joining me here on the Baseline, and we'll catch you the next round. All right. Cheers, everybody.